Recently, I asked you fine people what you wanted to know, and you guys delivered, and I received over 200 questions, but could only pick 5 for this video. With that many questions, I could have made like 43 different videos. So if you guys enjoy this one, then I'll go ahead and pick 5 more and make another video soon. Today, I'm gonna go over ETF only investing, which ETFs combined get me to $100,000 faster, taxable brokerage versus the 401k, and when or how to invest best, the best way to sell stocks or ETFs, investing with varying time horizons, and then 2 quick bonus questions. My name's Nolan Govea, my students call me Professor G, and I made this channel to make investing simplified. The first question asks, is it enough to invest exclusively in a handful of ETFs and literally nothing else? I'm an expat with no pension and prefer to keep things simple. Super quick answer on this one. Yes. I'd highly recommend reading the book Trillions by Robin Wigglesworth because the amount of data and the amount of case studies and everything else within that book just makes the easiest case ever that we should definitely be investing in index funds, and ETFs track index funds. And so that, to me, is the best way to invest in equities. What I'm definitely not saying is that just because you invest in ETFs, that's gonna get you to your overall investing goal or get you super rich. You still have to do the research and pick the right ETFs. But if the question is more so, can I just invest in ETFs and not have to worry about stocks or bonds or any of these other things? My opinion, definitely a hard yes on that. The best place for anybody to start would be in a broad market index like the S&P 500 or the total US stock market. I like the idea of keeping it simple there, so good job. Bob the Builder asks, but seriously, he asked, what mix of ETF combined can get me to $100,000 faster? First off, the professor in me is going to ask you to define faster. Since I don't know what we're comparing this to, I don't know exactly, but what I do think that you're asking is what types of ETFs can we put together to get us to $100,000 the fastest? And if I knew that, I'd certainly have a lot more money, and probably most of you that are following me would also have a lot more money. Spoiler, no one knows exactly which ETFs to put together to get to the fastest $100,000. And if they do say that they have the answer, run fast. Here's what I can tell you. Piles of data suggest that for the average investor to become a millionaire, one needs to have a broad market investing strategy and to stay consistent. Specifically investing in something like the S&P 500 or the total US stock market with an average yearly appreciation of over 10% has been the move. One could invest $500 per month in something like that, and in 30 years would have about $1 million. To supercharge that a bit, I like to add in a growth ETF or two into the mix, because some of the best ones have consistently hit 15 to 18% appreciation yearly. For perspective, if one were to invest the same amount, $500 per month, into one of those type of ETFs and received 18% consistently for 30 years, they would be at over $4,800,000. That's quite a bit different. The issue with putting all of your eggs into that one basket is that even though you're getting that possible high reward, you're definitely putting yourself into somewhat of higher risk. So to keep your reward somewhat high, but also pull the risk down a little bit, I like to add in the growth ETF to that foundational style ETF rather than going 100% growth ETFs. And then to balance everything out, I add in a much safer cash flowing passive income type ETF like SCHD or VYM, so you're getting the best of all worlds. So to answer your question, the best way to get you to that $100,000 faster is to pick multiple ETFs with these 3 categories and then do whatever you can to get more gas on the fire. Adding in as much capital as consistently as possible is what's going to get you to that $100,000 so much faster. Check out my videos on my 3-fund portfolio for more information on all of this. I got this next question from Penguin Pat. And fun fact for you all, penguins are my favorite animal of all time. I have no idea why, but I seriously love penguins. I'll go to the zoo or aquarium and hang out with those little guys for hours. I'm not embarrassed, you're embarrassed. Anyway, Penguin Pat asks, is it ever a good idea to invest with a taxable brokerage account before you've maxed out your 401k? I'd love to have access to some of my investment returns before retirement. Yes, this is a good idea for exactly what you said, but also for another reason. Having money in your 401k is so important because retirement is coming, y'all, and you need to be prepared. You also get a tax advantage by putting money into your 401k because then that brings down your taxable income for that year, and so you have to pay less taxes. But you can't access those funds until age 59 and a half or later, so if you do want to take advantage of some of those funds earlier than that age, it would be very smart for you to start putting a portion of your money into a brokerage account as well. Within the brokerage account, you can pull out your money at any time with no penalty. But when you sell the stock or ETF in order to pull the money out, you will get taxed on the capital gain part of that portion. So if you buy a stock for $100 and then it goes up to $150, you're gonna have to pay a tax on that $50 that you profited. Now, the other reason why I say it is a good idea to start putting money into a brokerage even before maxing out your 401k is because in those 401ks, they're pretty sneaky about how high those fees actually are. Most of the time, you're paying a fee of 0.50 to 1% as an expense fee for the funds invested in your 401k. For context, if you were to invest in the S&P 500 through the Vanguard S&P 500 fund in your brokerage, you're only paying a fee of 0.03%. The difference there is an expense that is 10 to 20 times less expensive, and long-term will make your compound interest grow so much faster. I'd highly recommend you checking what the fee is that you're paying currently in your 401k, because most people don't know. This next person asked, I'm trying to shift some funds more toward dividend ETFs out of pure total market. Is there any advantage to dollar cost averaging out of something as well? Great question, and yes, the same thing applies. We dollar cost average due to the psychological aspect and because data has shown that the average buy price over time is a very smart move. Unless something crazy happens where your investment goes up like 10,000% in one night, where you definitely should probably sell that because that gain is insane, a smart move would be to dollar cost average to pull the money out. But there's some things that you have to consider. Like number one, with your example, you're saying that you want to sell out of one fund and put it into another fund. And if you're dollar cost averaging out of one fund, the idea there is that hopefully you're getting the most amount of profit within that fund. And so that's when you're pulling out the money. But you have to keep in mind that you're probably going to be buying into another fund that's probably profiting similar. If market's going up, usually other ETFs are going up at the same time at some level. And so yes, you're getting more profit out of this one ETF, but if you're then just going to buy this other ETF at a higher price than you would have bought it like a day or two ago, kind of evens out. The thing that you really need to think about is, where is this money? So specifically, is it in a brokerage account, your 401k, a Roth IRA, traditional IRA? Because if it's in a retirement account, then you don't have to worry about taxes when you make a sell. But if it's in a brokerage account, even if you're taking that money directly from the ETF and putting it into another one, so you're not actually taking those gains or seeing the money, you still are taxed when you make the sell and when you move the money to the next place. So you do have to take that into account. And so that's why some people don't sell out fully in their position, say it's 6 or 7 figures worth, because when you sell that out, that's going to be a huge tax hit. Whereas if you just sold like 10% or something, then that's more manageable amount of taxes that you're paying to move it over. Last thing that you want to consider is, how serious are you about moving it into this next position? Because if you've done all the research and you just believe like, yeah, I don't want to do this ETF anymore, I think that this is the one, then it just makes sense to cut and start that new position. But for most people, you want to dip your toe in the water, see how it kind of works, and then go slowly from there. It all really comes back to that whole idea of the psychological reason why we dollar cost average. That kind of keeps your emotions in check, that keeps you mentally strong, and it helps you just kind of like ease into it. Ethan asked, my question's how to invest for life goals with different time horizons, such as buying a house, buying an engagement ring, retirement, etc. I love this question because it shows that you're actually wondering and trying to think about why you're doing these investments and what specifically is the goal for why I'm putting this money into this place versus this place. I hope you all are starting to do this. There are pros and cons for having your money in the stock market versus having your money in like a high yield savings account versus having your money in Bitcoin or real estate. there's different reasons why you put money in different places. Some are longer term outlooks and some are short term. Some don't really matter if the market crashes in the next year, 2 years, 5 years, especially if you know you're not going to touch that money for 20 years. For anything where you think that you're going to actually need that money, you're going to need to pull it out within 5 years or less, I would suggest having the bulk of that in the safest place possible, while still earning at least a little bit of interest. So this would be like a high yield savings account, a CD, possible short-term treasuries. There's also the case that this could be in like the S&P 500 in a brokerage account. But just know that there's a level of risk there. For example, if you had planned to buy a house or some big purchase in 2022, and at the beginning of 2022 you had $50,000 ready for that down payment, but you didn't need to buy the house till the end of the year. If you had your money sitting in the S&P 500 in January of 2022, by the time it hit that December in 2022, the S&P 500 was actually down over 18%. So if you wanted to sell, you'd actually only have $41,000, not $50,000. On the flip side though, the S&P 500 could be way up. Like this year in 2023, in total return at this point at the end of December, the S&P 500 is up almost 25% with dividends reinvested. So your $50,000 would actually now be $62,500 in just 1 year. This is why I and so many other investors advocate for having money in multiple places. Having a solid built-up amount of money in your savings, specifically in high yield savings account, is so great. Having retirement building, especially monthly and consistently monthly, is great. Adding to a brokerage account, a taxable brokerage account, is a great idea. But just remember that if you need a certain amount of money by an actual certain time, like in the example, if you were actually going to be buying this engagement ring in 6 months, the stock market is not guaranteed to go up and actually can be quite volatile and could go down, especially in the short term, like 6 months. So I'd have that kind of money in a high yield savings account, especially nowadays when you're able to get a guaranteed rate of between 4 and 6% to just park your money there. Now just remember, especially with Powell coming out and saying that they're going to be cutting interest rates next year, that means the high yield savings account and other guaranteed account rates will go down as well, so keep your eye on that. The last 1 or 2 bonus ones here asked me about me personally, and they asked, what's next for you in life and career, Professor? And how's jujitsu going? How long have you been training? Well, anyone who actually trains jujitsu probably has the same answer, and my answer is it's going great, but it could always be better, and there's always so much to learn. And so I love it because it's something that's totally different than what I do daily with finances or being a professor. I get to shut off my brain there, and I get to go compete every single time that I'm rolling with somebody. It teaches a lot of discipline and a lot of resilience, which definitely carries over to all areas of life. As far as what's next for me in life and career, honestly, I'm just trying to take it one day at a time. I used to be somebody who was very, very big goal oriented, and yes, I do have goals and they are there, but I'm not just shooting for what's happening later. I'm trying to really focus on what's happening today and the fact that we're blessed with just even being able to have this day and be on this earth and enjoy time with loved ones and just have a good time. My goal, honestly, is just to become a better professor and to do better on these videos and try to give you as much value as possible. So if you enjoy what I do here on YouTube, please give this video a like, tell somebody about the channel, and remember to keep investing simplified. Watch this video next to keep going on this financial journey.